Welcome to Momentum Monday. Today is May 8th, 2022. Happy Mother's Day to all mothers, and Howard, happy anniversary.
Sir, it's good to be home. It's hot here. How's the weather in San Diego?
It's a bit cold actually. It's like
Come on.
67 and cloudy, but not bad.
Yeah, it'll be sunny tomorrow though, probably.
Probably, yeah.
So it's disgusting out there. I was saying I've had so much screen time, and it was just one of the worst weeks ever to have to stare at a screen.
Did you do any trading or just watch?
No, I'm pretty good at doing nothing. I mean, I bought a few things just long term for myself, but nothing that make a dent in my portfolio either way. I expect, just looking here at the charts, that things trade much lower, but at the same time, there's conditions for a rally. So what are you seeing?
What I'm seeing is just a lot of volatility and choppiness. As you saw last week, we had on Wednesday like a 5% up day, and then the next day we erased the profits. We had a down 6% day. So there is a lot of back and forth. Obviously, the overall trend is down. All the major averages are below their 20, 50, 200-day moving average. So we're basically in a bear market. And granted, in a bear market, we can have some insane short-term rallies, but overall rips tend to get sold. And I mean, just to give you a perspective of how much selling there's been, I just want to show you one chart, IWO, which is the Russell 2000 growth ETF. It has given back its entire profit from 2021 and 2020. So last 2 years are basically just the previous 2 years are wiped out. And obviously, I mean, there's some
venture capital index has done the same thing. I didn't know there was one that existed. It's Reuters has an index. The only reason QQQ hasn't is because of Apple and Microsoft.
Yeah, obviously, and the S&P has done better because of energy and basic materials. But
yeah, but you take out S&P, you take out Microsoft and Apple, and I guess Exxon in the S&P, and you've got I don't know if Exxon's in the S&P, and you're
it
down
is, yeah,
there.
for sure it is, yeah. Yeah, it's one of the biggest companies, yeah. So yeah, I mean, you're definitely right that there's been a lot of selling going on, a lot more in the like so-called growth stocks, and in any company that really doesn't produce positive cash flow, that just doesn't have any earnings. When interest rates are rising, all of a sudden cash flow matters.
That's unbelievable. So the biotech index is below the COVID.
Almost there. Just
all
about
that
10%.
Basically, all this innovation was for there to be a biotech boom, and what a risk off. I mean, this is all rates. This is all rates.
It's all about rates, all about quantitative tightening. So all of those businesses that are like high price to sales, high price to earnings, or that don't have any earnings or positive cash flows, they can go down substantially because the market just assumes that in this environment they'll have to raise cash just to survive, and which means either diluting shareholders or just taking loans at much higher interest rates. So this is why we're seeing all that pressure. It's anyone's guess how long it's gonna last.
Well, I don't think you're gonna get the Fed. I mean, this government, the last government, I mean, it had been so politicized, but the Fed is so far behind the curve. And I think the Democrats are so behind, not on the same page with each other. And that far left just wants the market to die, because they think only the rich own stocks, which is partly true. And then the Fed, they kind of done their work by like getting everybody out of tech without rates going up. But the rate of change of rates, I think, is what's the unintended consequences are, and that's where you get a recession.
Yeah, eventually.
That looks like a tech stock.
Yeah, but it should be
crash.
one of the most conservative ETFs, the 20-year Treasury
Yeah,
bond
go to
ETF.
look at a monthly on that.
Yeah, it's a pretty
So
intense sell-off.
really intense trend break. And then if you look at XLE versus the versus the Qs since the pandemic started, I shared the chart earlier, but the energy index is ahead of the Qs since the bottom.
Yeah,
or since pre-COVID.
Yeah, it's possible.
So you have a massive change of trend. Everything that I had held dear, I don't know, for 10 years, QQQ's over SPY, that trade's over. It doesn't mean you can't own tech. It just means, you know, we're in the beginning of a massive potential trend shift. If the cost of money goes up, money will go to more profitable type businesses much quicker. Especially since venture returns have given back a lot of, you know, 3 years of gains, at least the growth areas. So cash can tighten up pretty hard here. Money won't come completely out of the markets. You can see it in the S&P. It'll go into profit generating businesses and out of businesses that take 10 years to get to profits. That's just exactly the way it works.
Yeah. I mean, even during the bear market here in the early 2000s, there were stocks that were making new all-time highs, like Panera Bread and others. So you have new trends. I mean, granted, for the indices, for the Qs, maybe the next 5 years might be just flat, but during that time there'll be other trends.
Yeah.
So
yeah, I'm starting to look for all-time highs. Have you seen anything, Ivan? You know, as the market craps out here.
It's energy. It's just basic materials.
If it's just energy, I'm not interested. But there'll start to be some.
I mean, a few names like from last week, but I think I mentioned LNTH kind of made all-time highs when the market was crashing. So it's kind of holding. You just need probably the market weakness is just keeping it down. It's a small name, and obviously last week there were a lot of strength in the lithium names. Tremendous growth for in that industry because a lot of companies are trying to switch to building electric vehicles. So there is a lot of demand. They're definitely showing accumulation here, big earnings gap, just going sideways. They might just need more time. The other one, AOB, which is a bigger one. So this is where kind of the strength is, other than obviously energy. Energy just keep making new multi-year highs.
Yeah, the markets aren't going to completely settle. If it's just interest rate driven tech stocks, there's a lot of profits to be had. And so we'll have to start looking for some, you know, growth names within these sectors. But right now it's all, I think, commodity driven and energy driven.
So if you had to short one stock for, let's say, the next 6 months, which one would it be?
You know, it would probably be the semiconductors.
A sector, semis, okay. Let's take a look. Longer term, yeah, definitely looking vulnerable. Even though they kind of came up with decent earnings this earnings season. I mean, the market didn't care; they just sold them.
Yeah, I just worry about supply. If you go into a weakening economy, people will just stop buying this type of stuff.
Yeah,
not their phones, but Apple kind of controls their own supply chain at this point. So. But I don't know. I mean, I don't short, and I wouldn't short. I hate shorting into VIX, with the VIX 35, kind of.
Yeah, VIX elevated. Yeah,
it's just starting to perk up, huh?
Yeah, especially last week. That's why I said volatility is definitely high, and therefore choppiness is high.
But below March, below the spike in March, so. I don't know. There's not a lot of fear. It just seems like everybody's slowly giving up on tech.
I mean, we're still having stuff like GME that is still way above its, you know, area from here. So I'm kind of thinking until we see GME and AMC basically giving back the entire gains from the past 2 years.
Yeah.
Maybe it's not over.
Even Trump stack, like I watch that and go, you know, who owns that? And then I was looking at some other stupid stocks from that genre. So yeah, there's still, and then if we look at Tesla, starting to crack a little bit.
Yeah, definitely. Ever since that Twitter fiasco, but maybe that's not really the only reason.
Yeah.
Below it's 200-day, below it's 50-day, kind of bear flaggish here, despite record earnings. So I guess valuation
wouldn't short it. This has got a lot of fuel in there. But I was looking for some names that I'm just like, no, I think when we get a bounce, it'll be a better time for people to assess. A bounce will come.
Yeah.
Right now, there's a lot of hate selling. Even I've been considering just cutting bait and just lowering exposure, even in my little exposure I have, which means, but eventually, and you saw it with Zillow, like they came out and I don't know, the numbers weren't horrible, I guess, but the stock closed off its lows, right? So
yeah, definitely near the highs of the day. So
at some point, these will go up on bad news. We're not there yet, though.
But it was the same with Facebook. We're kind of seeing it in several names. It's a different question if it's sustainable as of right now. So
yeah, but in the bear market, that'll still just take out its lows. So we'll see. But I don't really have any much data. I mean, we've been pretty cautious. You're probably high cash.
I'm high cash. I'm just taking the occasional intraday or really short-term swing, but mostly high cash overnight, and just trying to add a little bit here and there, but definitely not aggressive and not really expecting to make a killing in this market. I'm just trying to survive until the next bull market. So
okay,
yeah.
All right, everybody. Just gotta hang in there, and you gotta wait this stuff out, and the market gets better eventually. But right now, I think doing less is kind of what we've been recommending.
Oh yeah, for everyone, doing less. Even if you're an intraday trader or a short seller, just doing less is better in a highly volatile tape. You need to slow down.
Ellen says hello. All right, buddy. Everybody have a great week. We'll see you next week.
Yeah.